The U.S. imposed 25% tariffs on $50 billion worth of Chinese imports. Beijing immediately threatened to strike back with similar penalties on over 600 American products, from cars to soybeans and seafood.
The United States takes unilateral protectionist measures harming China's interests. We will quickly react and take necessary steps to resolutely protect our fair, legitimate rights.
Not long ago, Trump stood on stage bragging that he'd finally tamed China, slapping tariffs, bringing jobs back, and ending America's dependence. But today, that illusion just shattered. China has hit back with a brutal $50 billion in tariffs on US goods, targeting everything from agriculture to tech. And now Washington is learning the hard way. When your phones, homes, cars, and crops all rely on Chinese supply chains, payback hurts. The White House didn't see it coming, and as panic spreads across markets and ministries, one question is becoming impossible to ignore. How did the US let itself get this exposed? And is this just China's opening move in a much deeper economic war? Because it came without a whisper of warning. At exactly midnight in Beijing, China's Ministry of Commerce issued a 6-line press bulletin that sent financial markets spiraling before most of the world had even opened their eyes. Effective 6 a.m. local time, the Chinese government would impose a sweeping $50 billion in tariffs on American goods. The measure targeted over 3,400 product categories, everything from US soybeans to semiconductors, aircraft parts, electric vehicles, and liquefied natural gas. There were no hints, no leaks, and no diplomacy, only cold retaliation. What kind of superpower strikes without saying a word, then watches the world burn? Chinese state media wasted no time framing the move. On every major outlet, from CGTN to People's Daily, the language was deliberate and defiant, a strategic countermeasure against US economic aggression. For Beijing, this wasn't simply about trade. It was about humiliation, containment, and asserting dominance in a global order it sees slipping from Washington's grip. Every export sector that underpins US economic leverage had just been hit with a brick wall. This wasn't a skirmish, it was an ambush. And the next strike isn't economic, it's geopolitical. The damage wasn't evenly distributed, it was targeted, ruthless, and data-driven. American agriculture, already walking a tightrope due to climate stress and falling subsidies, saw its lifeline cut. China was the single largest buyer of US soybeans, with $14.2 billion in annual purchases. Now slapped with a 35% tariff, tech giants weren't spared either. Semiconductor exports to China, which brought in $7.3 billion last year, were now classified as strategic risk goods and penalized with up to 50% surcharges. LNG shipments, particularly from the Gulf Coast, were taxed at 20%, directly undercutting deals signed just months ago. These weren't random figures, they were economic pressure points. This wasn't a warning, it was a chokehold on America's economic arteries. Wall Street reeled. Before the markets even opened in New York, the futures market signaled red across the board. The Dow Jones dropped 840 points pre-market, while the Nasdaq hemorrhaged 3.6%, driven by panic dumps of tech and industrial stocks. Boeing plummeted over 8% in pre-trade hours, Tesla 6.1%, and Intel 4.3%. Oil prices spiked to $92 a barrel as traders braced for a slowdown in trans-Pacific energy movement. Gold shot up instantly as investors fled to safety. It wasn't just a market correction, it was a psychological reckoning. How long can a superpower keep printing confidence while its economy bleeds in silence? Inside the White House, chaos unfolded behind tightly sealed doors. Sources close to the National Security Council confirmed that President Biden was woken shortly after midnight by an emergency call from Jake Sullivan. According to the leak, there had been a brief, cryptic back-channel warning from Beijing just 12 hours prior, sent through diplomatic intermediaries in Zurich, but its seriousness was underestimated. By 2 a.m., a high-level crisis meeting had begun, with Commerce Secretary Raimondo, Treasury Secretary Yellen, and Pentagon trade analysts dialing in from multiple secure locations. There was no clear plan. The retaliation came faster than the policy. And in war, whether military or economic, speed decides who buries the other. What's most disturbing is how the United States, with its multi-billion-dollar intelligence budget, didn't see this coming. There were no intercepted communications, no satellite alerts, no diplomatic signals. Not even an op-ed from a state-backed economist hinted at this scale of economic assault. The silence was too clean. routine, almost rehearsed. Intelligence analysts now say it was a blackout operation run by a closed circle inside Zhongnanhai, China's central leadership compound. The US, for all its military satellites and AI-driven surveillance, was blindsided in real time. If this is how Beijing plays its economic cards, what's hidden in the military deck? There's another layer to this crisis, one the average consumer won't feel until it's already too late. Everything from your smartphone to your refrigerator, from the plane you fly in to the tractor that plants your food, relies on at least one component affected by these tariffs. Prices are expected to rise within weeks, first in manufacturing, then in grocery aisles, then at the gas pump. Job losses in agriculture, aerospace, and energy are already projected to hit 240,000 in the next fiscal quarter if trade flows aren't restored. America isn't just facing a trade crisis, it's facing a consumer collapse. You don't need to invade a country to break it, you just need to raise its grocery bill. The timing couldn't be worse. With inflation still hovering above 3.4%, the Federal Reserve caught between rate hikes and stagnation, and a pivotal election cycle brewing, this economic assault couldn't be more perfectly engineered. The tariffs act like a time bomb, immediate enough to rattle markets, slow enough to drain political capital over time. With Beijing holding the detonator and Washington caught in paralysis, the next move is more than just policy, it's survival. And if this was just the opening act, and what does China have planned for the encore? The timing of China's retaliation was not impulsive. It was a calculated response to a series of escalating US policies that Beijing perceived as hostile and humiliating. Just 2 weeks before the tariffs hit, Washington blacklisted 7 major Chinese companies operating in artificial intelligence, aerospace, and next-gen defense systems. The justification? National security concerns. But for China, this was nothing short of economic warfare, a direct attempt to kneecap its ambitions in global tech leadership. These blacklists weren't just symbolic gestures, they froze billions in foreign investment and cut off critical access to US technology. Was this ever about trade, or was it always about who controls the future of technology itself? The temperature rose further with President Biden's signing of the Chip and Trade Expansion Act, a sweeping measure that banned American firms from selling advanced semiconductor components to Chinese buyers. The law, passed with bipartisan support, essentially severed China's access to the high-performance chips needed for artificial intelligence, quantum computing, and hypersonic weapons development. For Beijing, this wasn't policy, it was provocation. Chinese officials described it as digital strangulation, accusing the US of trying to freeze China's rise before it reached parity. And now, the ice has shattered, and Washington may be standing on the thinnest part. But the final spark came not from a sanctions list or a trade agreement, but from a signature in Silicon Valley. Last week, the US-Taiwan Tech Pact was signed quietly in San Jose, committing both sides to long-term tech collaboration in microprocessor research and joint manufacturing. Though there was no formal ceremony, the signal was clear. Washington had chosen a side. China denounced the move as an economic betrayal, equating it to military cooperation disguised as industrial alignment. Diplomatic channels went silent within hours. This isn't just a shift in trade, it's the fracture of a global order. While policymakers in Washington debated strategy, the impact of China's counterstrike was already being tallied in boardrooms and farmlands across America. The US soybean industry, long dependent on Chinese demand, was perhaps the first casualty. China had purchased over $14.2 billion in soybeans from American farmers last year, making it the top buyer by a wide margin. The new 35% tariff makes those exports instantly uncompetitive, leaving farmers in Iowa, Illinois, and Missouri staring down the barrel of unsold harvests, plummeting prices, and broken contracts. And just like that, America's breadbasket has become a battleground. Tech wasn't spared either. The semiconductor sector, America's crown jewel of innovation, is forecast to lose $7.3 billion in export value to China in 2025 alone. Companies like Intel, Micron, and AMD, which rely on China for up to 25% of their overseas sales, have already begun reprojecting revenue and delaying expansion plans. Layoffs are expected, supply chains are freezing, even firms that don't sell directly to China are bracing for the shock, as global component flows begin to reroute toward BRICS partners and state-subsidized Asian alliances. Is Silicon Valley ready to survive without its largest growth market? Tesla, long hailed as a symbol of American tech dominance, faces a uniquely painful squeeze. Nearly 20% of Tesla's total vehicle sales come from China, and many of its batteries rely on Chinese-mined lithium and cobalt. With new tariffs on EVs and raw materials, Tesla stands to lose $2.1 billion in revenue this fiscal year. Worse still, Chinese state media has begun hinting at consumer boycotts, framing Tesla as a foreign entity profiting from anti-China aggression. The narrative is turning, and it's turning fast. What happens when patriotic anger becomes consumer policy in the world's largest market? In the energy sector, the shockwaves are already visible. China was the fastest growing customer for US liquefied natural gas, LNG, particularly from Texas and Louisiana terminals that invested billions to serve Asia. The new 20% tariffs mean those tankers may soon be redirected, and the infrastructure built for Chinese demand could go underutilized or become obsolete. Industry analysts estimate over $5.6 billion in direct losses from delayed shipments and canceled contracts within just 6 months. What good is an energy boom if you build it for a customer who slams the door shut? And then there's Boeing, the aerospace titan already reeling from the 737 MAX disasters and production delays. The company had just begun regaining ground in China with several large commercial jet contracts on the horizon. That optimism evaporated overnight. With Chinese buyers now seeking alternatives in Europe and domestic aircraft manufacturers like Comac, Boeing may lose up to $9.8 billion in projected deals over the next 5 years. Its final chance at recovery in Asia may have just vanished. The question now isn't who gets hit, but who survives the longest. The financial fallout began before Wall Street even opened its doors. Futures plunged as news of China's $50 billion tariff barrage swept across international markets. The Dow Jones collapsed by 840 points in pre-market trading, its worst opening performance since the COVID-era shocks of early 2020. The Nasdaq was hit even harder, down 3.6%, as tech giants like Nvidia, Intel, and Tesla led the freefall. For many investors, this wasn't just market volatility, it was panic with a paper trail. How do you calm markets when the world's two largest economies have turned their trade war into open conflict? Energy markets erupted in response. Oil surged to $92 a barrel, with Brent crude racing to keep up. The price jump wasn't due to scarcity, but fear. China's tariff on US LNG hinted at coming disruptions in trans-Pacific energy logistics. Shipping lanes across the South China Sea began to see last-minute route adjustments, triggering surcharges and delay forecasts. The energy sector, often seen as a stabilizer in economic downturns, had suddenly become another powder keg. And when oil rises because of fear, not supply, stability is the first thing to vanish. Currency markets didn't wait to digest the fallout. The US dollar index dropped 1.2% within just 4 hours, its steepest single-day decline since March 2020. Traders dumped greenbacks in favor of gold, the Swiss franc, and Japanese yen. But one currency moved the opposite way. The Chinese yuan surged in strength. Economists now suspect Beijing is artificially tightening its exchange rates to insulate Chinese manufacturers from rising costs, and to send a message to global investors. Confidence in the yuan is state guaranteed, unlike US resilience, which suddenly feels brittle. When Wall Street sees war in charts, Main Street feels it in jobs. Inside Washington, the mood shifted from confusion to chaos. A leaked internal memo from the National Economic Council, obtained by a whistleblower within the Department of Commerce, confirmed the worst. The Biden administration had no immediate contingency plan. Key sections of the draft tariff response strategy remained under review, and communications with trade allies hadn't even begun. Several staffers allegedly described the moment as complete disbelief, not because of the tariffs, but because of their own unreadiness. How does the most intelligence saturated government on earth miss the biggest economic ambush of the decade? President Biden, originally scheduled to appear at a farming summit in Iowa, abruptly canceled the trip and returned to Washington by private military aircraft. Sources confirmed he met with senior economic and military advisors in a closed-door situation room briefing just after 7:30 a.m. The optics were grim. A president meant to assure America's food producers was instead scrambling to respond to foreign pressure. What was meant to be a week of domestic policy victories had turned into a full-blown international reckoning. And while Biden returned to Washington, confidence in Washington kept fleeing. Across America's Farm Belt, the shock of China's $50 billion tariff strike is transforming into real, tangible despair. For Midwestern soybean farmers already facing devastating drought conditions, this latest blow threatens to finish them off entirely. With a projected 40% drop in soybean exports to China, their largest and most vital customer, thousands of growers are now staring down the barrel of insolvency. Grain silos are full, contracts are dead, and international buyers are disappearing overnight. Local banks are already bracing for a flood of defaulted loans by harvest season. And when factories fall silent, the American dream starts sounding like an echo. In Missouri, the warning signs have already become pink slips. A prominent regional steel manufacturer, which had long counted on China for bulk raw materials and exported over 20% of its finished product back to Asia, laid off 200 workers in one brutal morning. Their internal memo, now circulating online, stated simply, "Expected Chinese retaliation has forced us to preemptively restructure operations." There was no dramatic press conference, just jobs gone in the blink of a policy miscalculation. If one foreign signature can erase a town's income overnight, what are we really defending in this war? Farmers' unions from Kansas to Kentucky have begun issuing joint warnings. Their internal forecasts suggest this trade conflict could lead to the worst rural economic collapse since the 1980s grain embargo. That era destroyed thousands of family farms and gave rise to the modern industrial agriculture lobby. If the current trend holds, history may repeat, but this time with fewer lifelines and no political appetite for a bailout. Small-town economies, already stretched thin, are now being asked to survive an international standoff they never chose. And while flags wave in Washington, entire counties are running out of fuel, feed, and faith. On the West Coast, a quieter but equally destructive collapse is underway. Truckers, shipping companies, and port operators who rely heavily on Chinese imports and exports are staring down projected losses of over $12 billion in the next 6 months. Major ports like Los Angeles, Long Beach, and Seattle are seeing container traffic slow dramatically. Shipments are being rerouted, held in limbo, or canceled entirely. For workers on the docks and the highways, that means fewer shifts, fewer routes, and fewer paychecks. Trade wars don't just hit factories, they hit forklifts, families, and freight lines. While the public reels from immediate economic pain, analysts are beginning to piece together a more disturbing picture. This may not be a retaliation, it may be the beginning of Trade War 2.0. Economists now warn that the US-China rupture could be far more catastrophic than the 2018 tariff battles under President Trump. Unlike before, China is not just responding, it's replacing. The damage may not just be sharp, it may be permanent. What if the supply chains we depended on for decades never come back? China isn't fighting this alone. The expansion of BRICS, now including Brazil, Russia, India, and others, gives Beijing a backup plan the US cannot easily counter. China has already initiated major deals with Argentina for agricultural imports, Iran and Saudi Arabia for petroleum, and signed technology trade protocols with Russia. These aren't just substitutes, they're systematic alternatives. Where once China relied on the US to supply its growth, it is now building an entirely new trade architecture designed to exclude the West. And if America's best customer stops needing it, what does that make America? The World Trade Organization, designed to keep global trade disputes in check, has effectively been sidelined. Both the US and China are now ignoring mediation protocols and instead engaging in unilateral escalation. With no legal or diplomatic buffer remaining, the chance of a negotiated reset grows more remote by the day. Even multilateral forums like the G20 have gone quiet on intervention, wary of choosing sides in a high-stakes proxy battle. If the world's rules no longer apply, what's to stop this from becoming a trade war without end? Political analysts now openly frame the conflict not as an economic disagreement, but as a global power struggle. It is a proxy war for influence in 3 critical arenas: technology, defense, and energy. America wants to preserve its dominance. China wants to break it. And in the crossfire lie currencies, jobs, alliances, and entire political systems. The battleground is no longer trade, it's time itself. The real question is, who controls tomorrow?